You've spent years building it. You have revenue, you have customers, and you might even be making a profit. You think you're building wealth. You think that one day you'll sell this company and walk away with a life-changing check. But for 90% of small business owners, that day never comes. When they finally sit down with a buyer, they hear the two words that destroy their retirement plans: worth zero. A business that makes money isn't necessarily a business that someone wants to buy. In fact, the very thing that made you successful in the beginning is likely the reason your company is currently unsellable. Today, we are breaking down the brutal logic of the exit trap. We'll show you exactly why investors might look at your profitable company and see a liability instead of an asset, and how to fix it before it's too late. This is Business Explained Official. Hi and welcome. Before we begin, I'm curious, where are you watching this video from? You can let me know in the comments. I really enjoy reading them. Now let's talk about today's topic. The first reason your business might be worth zero is a hard pill to swallow. You haven't actually built a business. You've built a high-paying, high-stress job for yourself, and you are your own worst boss. In the world of mergers and acquisitions, there is a massive distinction between self-employment and a business asset. A job is something you show up to so you can create value through your labor. An asset is a system that creates value through its structure, regardless of who is sitting in the CEO chair. Investors don't buy your hard work. They don't buy your late nights or your passion. They buy cash flow that is predictable, scalable, and most importantly, transferable. If the magic of the company lives inside your head, if you are the lead salesperson who holds all the key relationships, the chief problem solver who fixes every technical glitch, and the only one who truly understands the product roadmap, then you aren't the owner of the business. You are the business. Imagine a buyer looking at your company. They see healthy profits, yes, but then they look at the key person risk. They realize that if you leave after the sale to go sit on a beach, the customers will leave with you because they only trust you. The employees will lose direction because they only took orders from you. The secret sauce evaporates the moment you hand over the keys. To a professional buyer, this doesn't look like an opportunity. It looks like a trap. They see an owner-dependent entity that is one heart attack or one burnout away from total collapse. Why would someone pay you $5 or $10 million for a company that requires them to work 80 hours a week just to prevent it from breaking? They wouldn't. They would rather take that money and buy a boring business with a management team and automated systems that allow them to play golf while the profits roll in. If you want to know if you have a job or an asset, ask yourself this. Could you sell your business to a stranger tomorrow, walk away completely, and be 100% confident that the revenue would be the same or higher 1 year from now? If the answer is no, you are currently paying yourself a salary to manage your own cage. You aren't building a legacy. You are building a liability that will expire the day you stop working. To understand why your business might be worth zero, we have to look at the math of the multiplier. Most founders think in terms of profit. They think, I made $500,000 in profit this year, so my business must be worth millions. But in the world of private equity, not all dollars are created equal. Investors look at your EBITDA, earnings before interest, taxes, depreciation, and amortization, and then they apply a multiplier based on the quality of those earnings. A low-quality business gets a 2 times or 3 times multiplier. A high-quality business gets an 8 times or 10 times multiplier. What is the difference? It's the difference between recurring revenue and reoccurring revenue. If you have to go out and kill a new beast every single month just to eat, if you are a project-based agency or a consultancy that starts every January at zero, your multiplier is in the gutter. To a buyer, that looks like a gamble. They have no guarantee that next year will look like this year, but if you have contracts, subscriptions, or a system where customers buy from you automatically, you have predictability. Now, here is where the trap snaps shut. Even if you have recurring revenue, if your churn rate is high, meaning customers leave as fast as they arrive, your business is a leaking bucket. A buyer will look at your churn and realize they have to spend a fortune on marketing just to stay in the same place. To them, your $500,000 in profit isn't an asset. It's a temporary windfall that will vanish the moment the market shifts. This is why some businesses with 10 million in revenue sell for less than businesses with 2 million in revenue. The smaller business had a better engine. It had higher margins, lower owner dependence, and most importantly, it had clean data. If your accounting is a mess, if you're mixing personal expenses with business ones, or if you can't prove exactly where your leads come from, you are handing the buyer a reason to drive your price down to zero. In a sale, you aren't being paid for what you did in the past. You are being paid for the confidence the buyer has in the future. If you can't prove that future with data, your business isn't a prize. It's a mystery. And investors don't pay millions for mysteries. Imagine you have a business that generates $2 million a year in profit. It sounds like a gold mine. But then a sophisticated buyer looks at your customer list and finds one name that accounts for 60% of your revenue. In that moment, your valuation doesn't just drop, it collapses. This is called customer concentration risk, and it is a deal killer. To you, that big client is your best friend. They pay the bills, they allow you to grow. But to an investor, that client is a single point of failure. If that one person at that one company decides to switch vendors or go in a different direction, your business isn't just wounded, it's dead. Buyers aren't looking for a lucky business. They are looking for a resilient business. Resilience comes from fragmentation. A business with 1,000 customers each paying $100 is worth infinitely more than a business with one customer paying $100,000. Why? Because no single customer has the power to destroy you. But concentration risk isn't just about customers, it's about platform risk too. If your entire sales funnel depends on a single Facebook algorithm, or if you sell 100% of your products through Amazon, you don't own a business. You are a tenant on someone else's land, and the landlord can change the locks whenever they want. An investor will look at this and see a house built on sand. They know that one policy update or one account ban could wipe out the entire investment overnight. Finally, there is supplier concentration. If your entire product line depends on one factory in one specific region, you are vulnerable to geopolitical shifts, shipping crises, or simple price hikes you can't control. If you want to sell your business for a premium, you have to prove that your success is a result of your system, not your circumstances. You have to show that you have diversified your risk so thoroughly that no single phone call can put you out of business. If your success is tied to a single thread, don't be surprised when a buyer refuses to pay for a rope. Let's talk about the most boring reason a multi-million-dollar deal dies in the final hour. The messy exit. When an investor or private equity firm looks at your business, they perform something called due diligence. This is a financial colonoscopy. They aren't just looking at your bank balance, they are looking at the integrity of your data. The biggest mistake founders make is treating their company like a personal piggy bank. If your business pays for your car, your family's cell phone plans, and your vacations, you are creating noise in the numbers. To you, these are write-offs. To a buyer, they are red flags. Every time a buyer has to dig through your personal expenses to find the true profit of the company, the valuation drops. Why? Because lack of financial discipline suggests a lack of operational discipline. A sellable business has clean books. Every dollar is accounted for, every contract is signed and filed, and every employee has a clear written agreement. If your intellectual property, your code, your brand, or your designs isn't legally owned by the company but by you personally, you don't have a deal. If your key employees don't have non-compete clauses, the buyer sees a risk of the talent walking out the door the day after the wire transfer. You have to build your business as if you are going to be audited by the toughest person you know. Remember, you aren't just selling a product or a service, you are selling a legal entity. If that entity is tangled up in your personal life, messy lawsuits, or undocumented handshake deals, it is toxic. Professionalism is the ultimate multiplier. A boring, well-organized business will always outsell a chaotic, genius-led business. If your records are a mystery, your price will be a tragedy. So how do you close the gap? How do you move from a business that is worth zero to a business that is a sought-after asset? It starts with a radical shift in your daily objective. You have to stop working in the business and start working on it. Every time you perform a task, you should be asking yourself, how can I make sure I never have to do this again? The answer is documentation. You need to build a playbook for your company. This isn't just a boring manual. It is the source code of your business. If a stranger can walk into your office, read your playbook, and understand exactly how you find leads, how you close sales, and how you deliver your product without talking to you once, you have just created millions of dollars in value. A playbook turns a guess-based business into a system-based business. It removes the key person risk and replaces it with process certainty. Next, you must attack your concentration risks. If one customer is too big, your number one goal for the next 6 months isn't just growth, it's diversification. You need to find 3 more customers of that size, or 50 smaller ones, until no single departure can sink the ship. Finally, you need to clean up your financial act. Hire a professional bookkeeper who understands M&A, mergers and acquisitions. Start running your company as if you are a public corporation. When you separate your personal identity from the legal entity, you aren't just making it easier to sell, you are making it easier to run. The value gap is simply the distance between your current chaos and a buyer's need for order. The faster you build systems, the faster that gap disappears. You aren't just building a company anymore. You are building an exit. The day will come when you want to stop. Maybe you're tired. Maybe you're ready for a new challenge. Or maybe you just want to enjoy the fruits of your labor. When that day arrives, you will either be a victim of your own success or the architect of a masterpiece. If you built the business around yourself, the sale will be a struggle. You will be forced to stay on for years in an earn-out period, working for someone else in the company you used to own, just to prove the value is still there. But if you built a system, if you killed your ego and replaced it with the playbook, the exit will be clean. You will hand over the keys, walk away with your check, and watch from a distance as the engine you built continues to roar. A business that is worth zero is a business that depends on you. A business that is worth millions is a business that has outgrown you. Don't wait until you're ready to sell to start making your business sellable. Start today. Build the systems, empower the team, and clean up the data. Because the best time to build an exit strategy was the day you started. The second best time is right now. You aren't just an entrepreneur, you are a value creator. Make sure that value stays behind when you leave the room. This is Business Explained Official. Build an asset, not a job. Thanks for watching.